Welcome back to the Spend Life Well show. Today we're going to tackle one of the most important pieces of legislation in recent years. That is the OBBBA, or the One Big Beautiful Bill Act. And yes, they did actually name it that. And what will this mean for your wallet, your business, and yes, your future taxes? So let's just jump on in, dive in here. What's in the bill? Well, before we unpack the market and economic implications of this, I wanted to give you a kind of a high-level overview of what this bill actually does. There are 5 main components, so let's take them one by one. The first one is the extension of the 2017 Tax Cuts and Jobs Act. Without the extension of these tax cuts in 2017, about 63% of all taxpayers would have seen a tax hike next year, to the tune of about $3 trillion additional dollars. This the bill preserves the lower marginal tax rates, so you will not see any changes in the marginal tax rates. The brackets are going to be changing just a little bit. They're actually increasing the size of the 10% and the size of the 12% bracket just slightly, but it's enough that some people will fall back down into the lower bracket this year. And the other things about that was they doubled the standard deduction, okay? Or not quite doubled, they increased it. And they're giving a more generous child tax credit. And some other key deductions were like the mortgage interest and the state and local tax exemptions. Although there's some caveats there. Right now, that state and local tax exemption, if you are itemizing your deductions, that cap for 2024 was $10,000. Now that goes up to $40,000. However, there are some limitations, and we sent a letter to or an email to our clients this last week talking about the components of the bill and some of the parameters. We will be doing a deeper dive in a future webinar coming up in the coming weeks. Right now, it takes time for the IRS to process all the bill and figure out how the new rules are going to take place. But that SALT tax exemption is going up to $40,000 with some pullbacks in that at certain income levels. So we'll try to cover some of those caveats in just a minute. So what were the things that President Trump promised in his campaign on taxes? One of them was no tax on tips and no tax on overtime. And the third one was no tax on Social Security. Now, Social Security is going to stay taxable, but this bill grants an extra $6,000 for seniors over the age of 65, but it will be phased out at higher income levels. So an additional $6,000 standard deduction for seniors over the age of 65, but it will be phased out. We're going to get the details to you later on this year. But that's going to affect a number of our clients as well. Also, too, for tips on overtime, there are new deductions, non-taxable things for up to $25,000 in tips and $12,500 in overtime. That's only going to run from 2025 through tax year 2028. It will expire in 2029. So that wasn't permanent. The income brackets from the Tax Cuts and Jobs Act of 2017 are permanent now. So there's some other changes. You know, it's interesting to listen to the media, depending on which side of the aisle you're on. You're either going to think that I'm too pro-Trump or I'm not pro-Trump enough. And that's okay. We all have our own individual perspectives on politics and things and how this bill is being portrayed. Only in Washington can you not change the tax brackets and call it a tax cut. Only in Washington can you have that happen. And as you've seen on other podcasts and our monthly updates, you really can't trust any politician. And I don't mean that in a negative light. They're going to put their spin on their viewpoint of what's really happening. There's a lot of myths that are going on and misconceptions that are going on about this bill. And there are some good things and there's some things that are not so good. So I just want to couch that in a way so that I'm not raving about this bill, because I think there are some problems. Other business-friendly tax changes. The big one is it introduced 100% expensing of capital equipment. Now, that's a big deal if you are trying to expand in your business. It also is allowing a full deduction of research and development costs. There's some enhanced deductions for corporate interest, and 100% expensing in the immediate year for those that are building a new factory or something like that. So that's about $100 billion in benefits for businesses in 2025 alone, and $130 billion in 2026. So I think that these are pro-growth oriented changes that will likely have some long-term economic impacts. The fourth big component of the bill is really about spending restraint. Now, this is where a lot of the controversy is. Instead of direct cuts, which this bill did not have, we're getting planned reductions in increases. So let me rephrase that just a little bit. No one's cutting Medicaid or student loans, but the increases that they're scheduled into the budget process and cycle, the automatic planned increases, are getting reduced. Not cut or stopped, reduced. And I saw a projection over 10 years that those things would add up to about $1.5 trillion in savings. Doesn't mean that they're cutting Medicaid. It means, or Medicare, that just means that they're going to eliminate some people who are not eligible for Medicaid, and they're going to try to implement some work requirements. I'll talk about that more in just a minute. But let's be candid here. $1.5 trillion or $150 billion a year in a budget that's approaching $7 trillion, that's not much at all. Another thing about the bill, which I didn't care for myself, was raising the debt ceiling by $5 trillion. And the reason they did that is because both parties in Congress are tired of pretending that they care about the debt ceiling. No one in D.C., as far as I can tell, wants to actually tackle the debt problem. And so this provision in the bill just buys Congress more time before they start having to make tough decisions. Okay, so let's kind of debunk some of the misconceptions that are out there that I've heard in the media. And like I said, depending on which news channel you watch, will impact your worldview on this. But I'm going to try to give you the facts of what's really going on. The first misconception is that this bill is nothing more than a tax cut for the rich. And that is not true. If this bill had not passed, we would have seen a dramatic increase in taxes, which in terms of collecting revenue for the government to keep the debt low is a good thing, but it would basically be, I think I said earlier that over $3 trillion of impact on the economy and your pocketbook. That would have slowed the economy dramatically and probably caused a recession. So the reality is, if you go back to 2017 with the Tax Cuts and Jobs Act there, many high earners actually lost deductions in 2017. And they would have actually benefited more from recapturing those deductions from 2017 had that Tax Cuts and Jobs Act expired at the end of 2025. So the standard deduction increase, meanwhile, is a major win for the middle-income households. In fact, those earning under $100,000 will see the biggest percentage in tax savings. Okay, so this is not changing. This is not providing another tax cut for the rich. The tax brackets are staying the same. And in fact, the bill in 2017, even though it was purported to give tax cuts for the rich, actually caused wealthy people's taxes to go up. So that's one big misconception. The other one I've already touched on just a little bit. The other misconception that's out there, because this is coming from the Republican side of the aisle, is that this bill will reduce the national debt. No, it will not. The way that the Congressional Budget Office does their budget forecasting and things, but we can't pretend, right, that tax cuts reduce the debt. There are some positive economic impacts, and in fact, we saw when taxes were cut in the 80s that actually increased the amount of revenue into the Treasury. But this is not going to magically cut the debt. In fact, we probably are forecast to add another $3 trillion to the deficit. That's the deficit, not the debt, in the next 10 years. So Congress still has to control their spending if they don't want the debt to explode. The other misconception, which I've touched on briefly, is that Medicaid got gutted, that millions of people will die because they can't get access to Medicaid or Medicare or health care. Medicaid's not getting gutted. Medicaid is simply having the growth of Medicaid expenditures curtailed. Not taking away from Medicaid, lowering the growth path and the growth rate for those expenditures. If it does attempt to remove ineligible enrollees and does add some modest work requirements, and it does phase out some of the COVID area expansions, it's really more of a reset button than actually cutting it, okay? So let's talk just for a minute about some of the what I consider as growth-oriented changes that will impact the economy. One thing that was left in the bill and made permanent was the small business 20% pass-through deduction, the Section 179 deductions and bonus depreciation, and then permanent R&D deductions. These will actually inspire businesses to spend more in those areas, to expand their growth, to build more factories and things, and that should create jobs and more economic expansion. So one of the things that I didn't mention earlier is there is some proposal on there that that's not a proposal, it's law now, that starting in next year, you'll be able to deduct some of your interest that you pay on auto loans. Well, that probably makes sense with the federal government because they like to borrow money and they want to encourage us to borrow money. So I don't know how much that really is going to impact the economy, just such as the tips and no tax on tips and overtime. I don't think that's going to have big impacts on our economic growth. That's my opinion. There are lots of opinions out there. So there's several things I don't like about it, and one is the increasing the federal spending. We have long since gone away from a zero-based budget, where every year a zero-based budget means every year you start over and you have to justify every expense that the federal government entails. We don't do that. In fact, we have actually passed a real budget in a couple of decades. And those are just continuing resolutions. This was a continuing resolution, the One Big Beautiful Bill Act, or OBBBA, if you want to call it for short. I don't think it's beautiful. It's certainly big, but I certainly don't think it's beautiful. So there is absolutely no effort whatsoever for Congress to rein in spending. And that amount of federal spending is increasing every year. And that will begin to affect future generations and our ability to pay our debt. So the big thing that is good about this is that the continuation of the Tax Cuts and Jobs Act gives certainty to the tax rates. It makes it permanent. It will take an act of Congress to raise rates from now on. And so that's some smart policy there, because businesses and us as individuals really do like to have certainty and predictability. One of the other things that I saw coming in are limits on the amount of debt that graduate students can take on. I also saw it's going to impact parents that are borrowing money for undergrad college for their children. They are going to limit the amount of parent loans. That's something we're going to watch very closely, because we don't want our children taking on more debt than they can handle with the degree that they're earning. Also, too, a couple of things. The estate tax exemptions are now set at $15 million. It originally was going to roll back quite a bit, and that's $15 million for individuals, $30 million for couples, and that will be indexed for inflation. So we got a lot of good things, and we got a lot of bad things, and some, not so good things. But I wanted to get this out to our clients and talk to you about it, so you get a little bit of a high-level overview on the One Big Beautiful Bill Act. That's a mouthful. And let you know that we will be having more information coming out about this and how it directly may possibly impact your financial situation. And we'll update you when that comes, okay? So for next time, join us. We'll be having podcasts released every week. But until next time, you've been listening to the Spend Life Well Show. Have a great day.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA, SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions.